Hello, hello. We're joined by Mr. Josh. It's a great day to talk about rates here today. Josh, how are you today?
I'm doing great, Jay. How are you doing?
Yeah, really nice. The weather's kind of turning around for us here in Edmonton, so that is awesome. Looking forward to spring in full effect. So, Josh, today Bank of Canada made an announcement. Looking forward to hearing your thoughts on that, and maybe stick around to the end of the video. We're going to discuss some of your options, whether you're a seller or you're a buyer. What should you do in the sort of rate environment that we're in here today? So, start us off, Josh. What happened today? What did the bank say?
Well, you know what? There were wide expectations that the Bank of Canada's rate announcement today was not going to be the time that they announced their first rate drop. There are still expectations of rate drops between now and the end of the year, but not today. So, as expected, the Bank of Canada kept its rate exactly the same at 5% today, which is in line with also what's been going on in the United States. The United States is they're at 5.5, we're at 5, but very, very similar and been very steady for several months. You'll remember the last time the Bank of Canada increased the rate was last summer. And we're expecting that sometime around summer this year is when the interest rates will start to decrease. But you know what, Jay? I wanted to talk about a little bit of not only the Bank of Canada's announcement, but how that impacts the fixed interest rates, or rather, what impacts the fixed interest rates. Because I feel like we spend a lot of time talking about the Bank of Canada, but not as much time talking about mortgage rates that are fixed, which is what most of us here in Canada tend to take most of the time.
Right.
So I'm not sure. Do you remember when they would talk about quantitative easing earlier in the COVID pandemic?
Yep.
That was the Bank of Canada. They were essentially central banks around the world are basically printing money and issuing bonds, which then lenders like mortgage companies would borrow money at a very low rate from the central bank and use that to basically pump a lot of money into the economy. And so, since the bank has decided to start tightening things up because of all of the inflation that all that extra money in the economy is causing, now they're doing the opposite of that. So as those bonds are maturing, they're no longer renewing them. So we call that quantitative tightening. So it's the opposite side of it. That's where we saw the fixed mortgage rates really bump up quite a bit since earlier in 2022. So the bank did announce today that in addition to keeping the rate the same, they're going to continue their policy of quantitative tightening. With that in mind, they then gave us a few clues as far as inflation, what they're seeing in inflation, and that helps us to see where we might see the bank start to lower its interest rates. CPI, or Consumer Price Index inflation, slowed in February to 2.8%. It's too early in April for us to see the April data. That'll come here in a few days. But they've seen easing price pressures on a lot of things. The bank's been concerned recently about the number of items within the CPI inflation that are still elevated. But a lot of those core measures, which is one of their preferred measures, a lot of those have been lowering, and they kind of look at a 3-month annualized rate. And over the last few months, that 3-month annualized rate is trending downward. So there is a lot of solid expectation by the bank that things are going to normalize, and the bank will actually expect to hit its 2% inflation target, which allows for a lot of price stability for Canadians. They're expecting that to happen early in 2025. But the good thing is we don't have to wait for inflation to get all the way to 2% before the bank will start to lower the rate, because if they wait that long, then it's going to go too low, and then we're going to start seeing more recessionary
Right.
pressures, which is not not at all what we want to be seeing.
Right. Is there any thought about this carbon tax affecting what's going on, right here with inflation? Will it change that, or is it too small of a metric? Was there any conversation of that today?
You know what? The conversation that is there, I don't believe it's in the Bank of Canada's announcement specifically, but it was in the Stats Canada announcement about the inflation. They listed a
Right.
number of items that are still continuing to push or provide inflationary measures. And of course, we always talk about mortgage interest costs and we talk about rent costs. But
Right.
one of the other major ones that they did mention was fuel costs and oil prices. Oil prices alone are about $5 a barrel higher than the forecasts had shown. Of course, we know that's very volatile, so it's almost impossible to forecast that. But absolutely, the carbon tax and the impact it has on fuel prices, on natural gas prices, et cetera, of course, that's going to have some impact on just the baseline costs of those things, because it's not like we can really adjust how much fuel we're using without making major changes, right? You still have to drive places. We still have to heat our homes, right? Remember the cold snaps this past winter across Alberta? A lot of fuel was being used just to keep everybody's homes warm. And of course, unless everybody immediately switches to electric vehicles and the technology very rapidly improves so that big trucks and stuff can operate on that as well, then, there's really no way of getting away from consuming fuel in at least the next several years. So we're going to continue to see that for sure, doing that. We talk about mortgage rates a lot, right? We talk about the variable rate in the Bank of Canada, but most people aren't taking variable rate mortgages, especially with most of those above 6%. So we do see a lot of people looking into fixed interest rates. A lot of people are taking the 3-year terms, sometimes the 5-year term, because it's often a bit lower than the 3-year terms. But what's interesting to see is that the fixed mortgage rate pricing is heavily impacted by the bond market. When I first started doing mortgages almost 20 years ago, the prevailing opinion was that it was the U.S. bond market that impacted our pricing. But as I've monitored it and learned more over the years, it really is tied to the Canadian 5-year bond yield and the 3-year bond yield for the 3-year mortgages and stuff. But where they're talking about how it's American bond rates that impact it, you can see here on this graph, I'm going to keep it on the screen for a little bit. There's 2 lines. One is blue, and that's Canada's 5-year bond yield over the last 6 months or so. And the other is green, and that's the American 10-year bond yield. And while the rates aren't exactly the same, the scales are a bit different on both sides, you'll see that when one goes up, the other goes up. When one goes down, the other goes down. And, if we want to talk about a causal relationship, Canada's a lot smaller than the United States. So it's not activity in Canada that's impacting the American bond yield. It's the other way around, right? So when we see strong employment in the United States and reason for those to go up, we tend to see similar impact here in Canada on the fixed rates. And unfortunately, in the United States, this morning, their inflation data came in. Canada is still pending. So I've got 2 lines on the screen now. I know they're pretty skinny if you're looking at this on the phone, but the orange line there, that's the US inflation rate over the last year. And it's very similar to Canada's. We hit a peak 2 years ago, and it's really dipped over the kind of last summer, and then it came up again in the fall, and we're slowly trending back down where we need to see it. But the US has been seeing an uptick that we haven't seen. And so we're hopeful that our inflation will continue to be on that downward trend. In February is at 2.8%, but the US inflation hit 3.5% today. We immediately saw the 5-year bond yield in Canada jump over 10 points. So we might see some pressure on fixed rates, upward pressure.
If you look, though, like March to March, right? I mean, we're still considerably lower, though, even in the U.S.
Yes.
So I guess we'll track what happens, the reaction to this. Mm-hmm. Will it pull us down or push us back up, right? That's all we can do now.
Pretty much, right? It's the trend that we want to pay attention to, right? So if the U.S. is stagnating there, great. At least it's not going up, because what happens is the U.S. needs to lower its rate eventually as well. But it can't do that until its inflation is more in check. But what happens, Jay, if Canada lowers its interest rate, then our dollar gets weaker because it's not attracting international investment the same way as when it's higher. And the side effect of our dollar being weaker is twofold. For Alberta and Ontario, for things that we export, it's actually really good for our dollar to be a little bit weaker because we sell things in US dollars. But the other thing is we import a lot of things in US dollars as well. And so those goods become more expensive. And so that actually causes some inflation. in Canada. So it's
Right.
it's a tough
Yeah.
one. And in the U.S., like the U.S. federal deficit in the U.S. is increasing by $1 trillion every 100 days. Like there's so much government spending, both in Canada and the U.S. Government spending is causing a lot of inflation as well. And
Right.
until that's
Yeah.
reined in, I'm not sure if it's going to totally go away and get where we need it to be. So that's a
Yeah.
tough one. Where that really leaves us, though, is we're gonna see interest rates trend down. Hopefully, in the short term, maybe a bit of upward pressure on those fixed rates, but hopefully we'll start seeing it to trend down. The bond market is, as of a few days ago, was still predicting about an 88% chance of the Bank of Canada's first rate drop to happen on June 5th. And I don't think that today's announcement is going to really change that very much. So June 5th, there's still a really good chance, if not by July. I think we'll see at least a 0.25% interest rate drop by the Bank of Canada, something 2 or 3, maybe not 4, but 3-ish rate drops by the Bank of Canada before the end of the year. And hopefully we continue to see some downward pressure aside from this hopefully short-term blip on the bond rates, which will do the same thing for our fixed interest rates, bringing us back and continually keeping us under 5% and hopefully closer to that 4% mark soon.
Right. So today's announcement really doesn't sort of rock the boat anywhere, does it?
Not
It
really.
did what we thought it would do. Yeah.
Yeah.
So for buyers, their pre-approvals haven't changed. They can't spend any more than they hope to. Sellers are still going to sell into a great environment. In Alberta, we're still ripping here, right?
Yeah.
So I don't think this will temper anything going on here at
I
all.
expect little to no change in Alberta. Truthfully, I expect
Yeah.
little to no change even in Ontario, or I say Ontario just because it's so big, so many people, right? And it has such an
Yeah.
impact on us as a
Yeah.
country. But Alberta's the economy is still doing well. Oil is trading higher than anticipated. We are still
Yeah.
having massive influx of population, interprovincial, not just international. So there's
Yeah.
pressure on our housing. There's some of the highest in wages in the country per household. And so only good things for Alberta. So yes, people
Yeah.
with their pre-approvals, things are doing well. And we are, last week we talked about the upward pressure on home prices in Edmonton. Honestly,
Yeah.
I feel like buying something, at today's interest rates of 5% versus waiting even 6 months, if the rate drops 0.5% or 0.75%, the increase in price on the home is going to outweigh the extra interest over the first few years. And then you still get to renew your mortgage in 3, 4, or 5 years from now at probably a much lower interest rate than we have today.
Yeah. So this is good if you're a seller, especially here in Edmonton. There's not enough inventory to go around. So if you're a seller, of course, yeah, please reach out to us. We'd love to help you. But if you're a buyer, then we need to get your solid pre-app done. Josh, you had to write that pre-app for me last week, or no, this week.
Yeah, it was just over the weekend.
This is pretty much, yeah, it's things we need to do to make the deals happen if you're a buyer. So we still got to be super aggressive. So yeah, that's okay.
Mm-hmm.
Market's still ripping, and we just have to keep going to work.
Yeah, exactly. So I fully expect to
Yeah.
see the market be strong this spring. You're seeing that already.
Yeah.
Anybody looking to buy needs to go in strong. So if you need that pre-approval, make sure you talk to me. And of course, we want to make sure that you're finding the right homes. And Jay, you're all-star at that for sure.
We try, yeah, for sure.
Awesome.
Well, thanks for the update, Josh.
Anytime, Jay.
Super helpful.
And please make sure that you click on like for the video so that other people see it more, and subscribe to the channel. Maybe hit that bell so you get our notifications when we're dropping videos for you every single Wednesday. Thank you so much, everybody.
Fantastic.
Thanks for being here.
Everybody enjoy the rest of your week. Thank you so much.
Bye.